Good afternoon, and thank you for attending this webinar on business valuation. I'm your moderator, Roxana Astorga from the Pace University Small Business Development Center. The Pace Small Business Development Center is a regional center of the New York Small Business Development Center. The NYSBDC is a U.S. Small Business Administration resource partner with regional centers at higher education institutions and outreach offices at other locations across New York State. Our no-cost, high-quality advising, education, research, and advocacy services are made possible by funding from the SBA, New York State, and our host campuses. Today's webinar will be presented by Dr. Marcus Braga Alves, Professor of Finance at the Pace University Lubin School of Business. In a moment, you'll hear from Mr. Raul Brown, Business Advisor at the Pace University SBDC. Attendees are muted and will not be on camera. Your chats will be visible to me and our presenters. If you have any questions, please don't hesitate to type them in the Q&A box or the chat. You can open your Zoom chat and Q&A box from the buttons at the bottom of your Zoom screen, and we will adjust questions during the presentation or at the end of the presentation. With that, I will turn over my time to Mr. Raul Brown.
Thank you, Oksana. My name is Raul Brown, and I am a business advisor here at the Pace University Small Business Development Center. As Roxana mentioned, the Pace University is SBDC is one of 20 SBDCs located throughout New York State, and SBDCs are resourced by the Small Business Administration, SBA. That's a federal agency. We are also resourced in New York by the SUNY Research Foundation. So both organizations send their resources here to Pace University in downtown Manhattan. And Pace uses that to hire me and Roxana and keep the lights on. But we focus, I mentioned downtown Manhattan, but the Pace University SBDC also covers Brooklyn through a series of satellite locations at prominent places. Brooklyn Public Library, Brooklyn Chamber of Commerce. And what we focus on mostly in the beginning is one-on-one free services to help you start and grow your business. So we help entrepreneurs through all stages of the business, from concept to growing the business. We have a host of resources available for them, starting with business planning to helping obtain financing, marketing, sales, business planning, international trade, government procurement, you name it. If we don't have an answer, we will look for a resource that can help you. We will look for that resource through our many resource partners that we work with for help with research, help with free legal advice, help with getting through government regulations. So we are open. Any questions you have as far as starting or growing your business, you should reach out to us. So among our many resources is having access to Pace University and its myriad programs, from nursing through business to many tech issues. So we have all those resources available, including access to world-class faculty like Dr. Alves. So I'm going to turn it over to Marcus now so that he can introduce himself and get the program started.
Thank you so much, Roxana. Thank you, Raul. I'm a professor at Pace University at Lubin School of Business, as Raul and Roxana mentioned. And my areas of expertise are corporate finance and financial markets. And I'm going to use this knowledge that I acquired through many years of study to discuss a very important topic here, a topic that I'm sure that's important for you as the Small Business Development Center that's here to help you to develop your business in a very holistic way, but of course, with a focus on what we believe that is very important, that is your business value. The topic for today, therefore, is what determines a business value. Our goal here is to have a very comprehensive understanding of the factors that result in a greater value for your business. Of course, we need to understand why this topic is important. The first thing that could come to our minds when we're discussing valuation is the amount that you could be able to sell your business for. But there's much more related to this topic. As Raul mentioned, the Small Business Development Center is here to help you to grow your business. How you're going to do this? You need to understand what affects your business size. And these factors are going to be closely related to what determines your business value. Understanding what affects your business value is also important when you apply for external financing, when you apply for a loan or a line of credit. Those who are lending resources to your business, they need to know to understand what's working, what's making your business grow, what's making your business popular among your customers. This is going to create a relationship between you and those lenders that hopefully is going to result in a lower cost of capital. To understand this complex topic, we need to focus on what matters most. What factors are going to help you to grow your business and increase your business value more quickly? Please feel free to ask questions during the presentation. We're going to have time at the end for questions and answers, but I'm happy to answer any questions that you may have before that. The first approach that we're going to discuss is called asset-based valuation. And it's a very simple approach, but it's very popular. This approach relies on the definition of assets and liabilities. Assets are what your business owns. Liabilities are what your business owes. If you subtract liabilities from assets, you have your equity that represents your business value. But before you estimate your business value using the asset-based valuation approach, we need to make some adjustments because assets are recorded based on their book value. Book value represents the amount that was paid, less any depreciation associated to this particular asset. We need to adjust this value, this book value, to represent the market value. Because what matters for us when you're assessing the value of your business is what the market understands that your assets are worth. There are some assets that may not appear on the balance sheet. Some intangible assets need to be included when we are calculating the asset-based valuation of your business. The liabilities are usually easier to estimate their market value because they represent how much you need to pay to those who are financing your business in addition to your own capital. Here we have an example of how you can use the asset-based valuation approach to calculate the value of your business. Market value of assets here is $400,000. This business is widely respected in the community, has a list of 500 loyal customers. This business has liabilities that add up to $35,000. To calculate the value of this business, we need to subtract $35,000 of the $400,000 market value of your assets. But you see here that the potential that this list of loyal customers may have in your business valuation is not included in this calculation. If this was a case that was really happening, we will need to recommend the business owner to discuss with the potential buyer the impact that this list of loyal customers might have in future cash flows. And that should probably increase the value of this business. Here we're going to have a few minutes to discuss this approach and see if we have an opportunity for a conversation throughout our presentation. The first question that I have is, how do liabilities affect a business value? I would like to know if you have some answers for this question. Anyone? How do we think that higher liabilities would affect your business value? Would increase your business value or would decrease your business value? Yes, exactly. Higher liability would decrease your business value because the asset-based valuation subtracts liabilities from your market value of assets. Now, the second question is, for what types of businesses is the asset-based valuation method a better fit? You saw the limitations of this approach. This approach requires us to estimate the value, the market value of our assets and liabilities. It also requires us to consider intangible assets that may not be reflected on your financial statements. Therefore, this approach may be better fit for some businesses than to others. Exactly. I'm seeing some answers here in the chat. High receivables, products that have value and strong market base, business with lots of fixed assets. Probably non-service businesses, high amortization, all very good answers. This approach is a better fit for businesses that have their assets fully represented on their financial statements. Therefore, the answers completely answer this question very well. Now we're going to move from one approach that relies on the balance sheet to assess the business value to an approach that relies on future cash flows and profitability. This approach is called seller's discretionary earnings, or SDE. SDE is based on the financial benefit that a business generate to its owner. It uses a multiple that's available in many different sources. Here we are going to use bizbuysell.com as one source to illustrate this concept. But before I show you this website where we can have this SDE multiple, I want to make a comment about the importance of having accurate financial statements to all of these valuation processes. We need to understand that these approaches, they require consistent revenue and expense recognition. They require us to record revenue when they are earned and expenses when they are incurred. I'm going to move to this website to show you how to use the SDE multiple to assess the value of your business. This is the BizBuySell website, and you're going to see that there's a lot of information here. The first table here uses a multiple that we can see in the last column based on what owners ask for their business. You can use this multiple to assess the value of your business, but you have to understand that this is based on how much owners ask for their business, not how much they are getting for them. Then if you go a little bit lower on this website, you're going to see that I have a second table that now you have the multiple here on this column called cash flow multiple average based on the value of the transactions as reported, as they happen. This is not the value that business owners asked for their business. This is the value that they got for them. We're going to use this table here to assess the value of business in our next example. If you scroll down, you're going to see that you have a multiple for New York area that's equal to 2.52. Before I move to our presentation slides again, I want just to show you that if you go a little bit lower, you have multiples also based on the business sector. You have agriculture, automotive, and boat sectors, for example. And one thing that I wanted to point out to is that you have businesses with lower multiples, like, for example, agriculture has a multiple of 1.18, automotive has a multiple of 2.7. As you're going to see during this presentation, there are many factors that influence a business value. One of them is potential for growth. And you're going to see economic sectors that have higher potential for growth with higher cash flow multiples. And you're going to see now how this is expected to affect the valuation of your business. Okay. To calculate the seller's discretionary earnings, we are going to start with the net income. But we need to add some elements to net income before we use the SDE for our valuation. We need to add items that depend on the owner's discretion, things that are very closely related to the owner's preferences. Like, for example, salary and benefits. What determines an owner's salary and benefits? If you have a small business, it's very likely that the owner decides how much they need as salary and benefits. In the case of small businesses, it's very likely also that the owner is going to decide how much the owner is going to need as personal expenses and discretionary expenses. We also need to add to net income expenses that are not likely to happen frequently. They are one-time expenses that are not supposed to affect the regular operations of your business. Now, once we calculate this value, we can use the average cash flow multiple that we saw on the website to calculate the expected value of this business. Now, in this example, we have a net income of $150,000. Owner's salary and benefits correspond to $50,000. Discretionary expenses correspond to $15,000. And one-time expenses correspond to $2,500. If I add these items to net income, I'm going to have an SDE equal to $217,500. And if I multiply this times the average cash flow multiple, I have the estimated business value using the SDE approach. In this case, it's going to be approximately $548,000. We can also work backward and use the SDE as a reference to know how much I need to get a particular amount that you believe that your business is worth. In this case here, suppose that you believe that your business is worth $700,000. With a multiple of 2.52, I can calculate what is the SDE that you need to obtain this amount that you believe that your business is worth. In this case, if I divide $700,000 by 2.52, I have that this business will need an SDE approximately equal to $277,778. Here I have other questions that may help us to check if we have completely understood this topic. Imagine that you are using SDE to assess the value of your business. What can you do to increase SDE? What decisions can you make to increase the SDE of your business? While we wait for answers to this question, I can answer Leslie's question here about the presentation. Yeah, we're going to make this presentation available to those who request. Yep. Yeah, we have here an answer saying reduce personal expenses and discretionary expenses, increase profitability. Very good answers. Increase your income if possible, and we need to make a big effort to make this possible. Very good answers. Exactly. And this is what we need to keep in mind. We need to keep in mind that these elements of a business valuation are the factors that we need to work on to improve in our businesses. We need to make sure that we understand that every decision that you make affect all these elements of the valuation that you have mentioned in the chat. And you have to keep this in mind daily. This is what you have to understand about your business, how you're going to make your business grow, be less risky. And these factors that we're discussing here are the ones that are going to make this happen. What will make the multiple used in the SDE approach increase? What do you think that will make this 2.52 average cash flow multiple increase if we're using the SDE approach? I mentioned one factor when I showed you the website. And while you wait for an answer here, I just want to make sure that if you want a copy of this presentation, please reach out to the Small Business Development Center, and I believe they're going to be able to send you a copy. Remember that I talked about the agriculture, economic sector. Yes, position within an industry. That is a very good answer. Yes. I was thinking about the economic sector itself, but the position of your business within the economic sector is a very good answer. It's much more in depth than the economic sector itself. Limit number of employees, intellectual capital. These are things that are going to help your business position itself better within the economic sector. That's very good. I'm very pleased with your answers. You are understanding these topics here very well. Thank you so much. Now, before we move forward, I just want to go over some definitions here related to the income statement. I'm sure that you have already seen the income statement for your business, and you need to understand these financial statements very well. The Small Business Development Center is here to help you to understand them. Uh, I want just to go over these definitions very quickly to help you understand the next approaches that are going to require these definitions. We have the revenue, that's the first line in the income statement. After that, we have cost of goods sold. If we subtract cost of goods sold from revenue, we have gross profit. Now, if we subtract sales, general, and administrative expenses from gross profit, we have earnings before interest, taxes, depreciation, and amortization. If we subtract depreciation and amortization, we have earnings before interest and taxes. If you subtract interest expense, we have earnings before taxes. And if we subtract income taxes, we have net income. If we divide net income by the number of shares outstanding, we have what it's called earnings per share. Earnings per share is defined in this small box on the lower right-hand side corner. Comparables are within the next approach that we're going to discuss here today. And the main idea to use comparables is that two businesses that are very similar, they should be sold for a similar amount as well. SDE multiple is a comparable. You can compare the SDE of your business with the SDE of other business within the same economic sector. That was one of the answers to my questions. That was an excellent answer, much more developed and in-depth than what I was expecting when I was discussing that question. Another multiple is called price to earnings ratio, or PE ratio. Price to earnings ratio is defined as the price of the share divided by earnings per share. And here you can see that if you have higher expected growth, the price of this share should be higher. And this is expected to give you a higher P ratio. Another comparable is called enterprise value ratio. Enterprise value ratio relies on the enterprise value instead of the price per share. And as we can see in this slide, the enterprise value is calculated as the market value of equity plus the market value of debt minus cash. And the ratio is defined as this enterprise value divided by earnings before interest, taxes, depreciation, and amortization. As you can see here, the enterprise value ratio is based on the value of the entire company, whereas the price to earnings ratio is based on the value of the equity. Therefore, the enterprise value ratio is less affected by external financing than the P ratio. Now, how we're going to use these comparables to assess the value of our business? Here you have two companies that supposedly are very similar. They report earnings in the amount of $200,000. The first company is selling for $500,000. The second company is selling for $475,000. Now, if I calculate the P ratio, in this case, I'm going to use the price that this business is being sold for divided by the annual earnings reported by this business. We have that the first company has a P ratio of 2.5 times. The second company has a P ratio of 2.375 times. Even though we started assuming that these companies were very similar, the P ratios shows us that the first company is expected to have a higher growth and or lower risk. This is why we have a higher P ratio, because if two firms, two businesses are very similar, they should be selling for the same P ratio. And in this case, one company has a higher P ratio that reflects expectations regarding its growth and business risk. We have two new questions here to discuss this topic. The first question is, what are the advantages of using the enterprise value ratio over the P ratio? Why would you use the enterprise value instead of the price per share in the valuation analysis? Would anyone try to answer this question? And think about this holistically. You don't need to know exactly the items included in the calculations. Think about you selling your business. When would you believe that the buyer would be interested in the enterprise value instead of the equity value? Yes, exactly. The enterprise value ratio is less affected by debt financing, right? And therefore, when the buyer is acquiring the whole company, the buyer wants to know how much would it cost to pay out debt and acquire the entire company free of external finances. Maybe the new owner would like to have a different financial structure here. Um, Maybe the new owner wants a company that's free of debt. Then that's the case where the enterprise value ratio would be more appropriate. Now, if the owner would like to acquire only the equity part and negotiate to keep the same debt structure, maybe even with the same um, lending institutions, that might justify the use of the P ratio, right? We have here when you are in a growth situation, more stable in value, earnings power could be greater than the equity in the business. Yeah, I love that you are thinking out of the box here. You're not being restricted to the formula to answer the questions. And this is the main goal of this presentation. We need to understand our business, the factors that are important when we are running the business on a daily basis. And all these factors are very important and very relevant for your business value. Now, the second question here is based on our discussion, what can you do to increase your business value? And actually, I can even use some of the answers that you provided here. You said growth, right? You said earnings power. These are very important for your business value. What else do you think that you can do to increase your business value based on this discussion up to this point? It doesn't need to be only based on the comparables approach, based on all the other approaches as well. What do you think that you can do to increase your business value? What are you going to do after this presentation? You're going to go back to run your business. What are the factors that you're going to pay closer attention now? Intellectual capital, this is so important. Small businesses, they rely a lot on intellectual capital in many different aspects. It doesn't need to be only related to technology. Intellectual capital may be your expertise on a particular economic sector, your relationship with your customers, everything that you can do that depend on yourself, your potential to add value to your business can be included in intellectual capital. Increase your market value and decrease your liabilities and debt. That's correct. But we need to remember that sometimes we need external financing to help us grow. It's a very important decision if you're going to borrow money to grow your business because that financing is going to work well when your business is doing well, but it's going to be difficult to manage in difficult times. And difficult times are going to happen. We know this, right? We had the financial crisis in 2008. We have many different challenges. We have the pandemic more recently. And these times, they're going to exist. And that financing is going to be very difficult to manage during crises. But we may need to use that financing to grow a business. Develop property and customer databases, yes. Customer databases, now we have AI, we have different technologies that we can use to develop our customer base and database, because information about our customers, it's very important. You need to understand your customer. You need to understand what your customer needs to provide these to your customer. Thank you so much for your answers. This has to be a conversation, and we're having a very nice conversation during this presentation. Now I'm going to start discussing concepts that are more difficult, they're more complex. And these concepts, they are concepts that we cover in our classes at Pace University. And if you have questions about this topic after the presentation, feel free to reach out, send me an email. I'll be glad to discuss this more in depth with you, but I'm going to cover this within the time that we have left. And if you don't follow completely, don't worry about it. This is a complex topic, and you need to spend a little bit more time understanding these concepts and what their effect on your business value, right? Now, the first concept that I want to address here is the timeline. The timeline represents different times when you're going to receive a free cash flow. A free cash flow is a cash flow that is available to the business owner. And the time value of money concept tells us that you need first to bring all these free cash flows to the same point in time to work with them, to add them. If it's one is a cash inflow, the other is a cash outflow, you will need to subtract the cash outflow from the cash inflow. But before you do that, you need to bring them to the same point in time. And to do this, you need to calculate the present value of this free cash flow. And the present value of the free cash flow is calculated as the free cash flow divided by 1 plus the discount rate to the power of t. T is the time when you receive this cash flow. T is going to be 1 if you receive this cash flow at time 1. It's going to be 2 if you receive this cash flow at time 2, or pay this cash flow, because cash flows you can receive or pay. Now, how do we calculate the free cash flow? We're going to start using the definition of free cash flow to the firm. That's the free cash flow that's available not only to the business owner, but available also to those who have business owners financing this business, right? We have here the free cash flow to the firm defined as earnings before interest and taxes. After taxes, this is the reason why I multiply earnings before interest and taxes by 1 minus the tax rate to calculate the earnings before interest and taxes after taxes. I add back depreciation because depreciation is not a cash expense. And I subtract anything that I need to invest in the company to keep my company operating, growing. In this case, I have to subtract capital expenditures and any money that I invest to increase my net working capital. Now, the present value of the cash flows are going to be calculated as the free cash flow available to the firm divided by 1 plus the weighted average cost of capital. That's the weighted average of the cost of the capital that I need to keep my business operating. At one point, I'm going to assume that this cash flow is going to grow at a constant growth rate. At this point in time, I can use the growing perpetuity formula that I have here represented by VT to calculate the terminal value of this company. This value is going to represent any free cash flow that you expect to receive after the company starts growing at a constant growth rate. And the terminal value is calculated as the free cash flow divided by, in this case, the case that I'm going to use the free cash flow available to the entire firm, by the weighted average cost of capital minus the constant growth rate. Once I calculate the terminal value, I need to calculate its present value to add to the present values of the other free cash flows that I estimated for this company. Now, there's another free cash flow that's very closely related to the free cash flow available to the entire firm. But in this case, I want to calculate the free cash flow that's available to equity holders. And to calculate this free cash flow, I need to subtract interest expense after taxes and add increases in net debt to the free cash flow available to the entire firm. This cash flow is only to equity holders. How do I use this free cash flow to calculate the value of my business? The same way that I did in the case of the free cash flow available to the entire firm, I need to calculate the free cash flow's present values. I also need to calculate the terminal value of the cash flows that I expect to receive after growth becomes constant. I calculate the terminal value using the growing perpetuity formula. But in this case, you're going to notice here that for the growing perpetuity formula and for the present value formula, I'm using the cost of equity, not the weighted average cost of capital, because in this case, I'm calculating the present value of the free cash flow available to the equity holder. Now, let's see how I apply this in an example. I have a company whose cash flow is expected to be $70,000 in 1 year. This cash flow is expected to grow at 10% per year for 2 years. After that, the growth rate is going to be 8% per year for the following 2 years. And after that, the growth becomes constant at 6%. Now, the first thing that I will need to do is to calculate the terminal value. The terminal value in year 5 requires us to calculate the free cash flow in year 6. The forecasted cash flow for year 6 can be calculated multiplying the expected free cash flow of $70,000 times 1.10 to the power of 2 times 1.08 to the power of 2 times 1.06 to reflect the 10% growth rate for 2 years, the 8% growth rate for 2 years, and the 6% growth rate forever. This calculation gives me a free cash flow in year 6 equal to $104,722. Using the growing perpetuity formula that require us to divide this free cash flow in year 6 by 0.16%, that is our discount rate, minus sorry, 16% minus 0.06, that is 6%, giving us a terminal value equal to $1,047,217. Now that I have the terminal value, I can calculate the present values of all the cash flows that I expect to receive if I own this business. Calculating the present values of these free cash flows, including the terminal value, I have a value at time zero equal to $767,980 approximately. And this would be the value of my business. What I can get from all these discussions that we're having about valuation approaches is that when we're running our business, we need to think about maximizing our cash flows and reducing our cost of capital. This is the core principle of valuation. We need to understand what we can do for our business to have higher cash flows and lower cost of capital. You have mentioned a few things already, and I list these things here with other things that have not been mentioned here, but you need to think about, right? The importance of our customers to our business value was mentioned a few times and is listed here as well. Intellectual property may lead to products and services that are unique, things that nobody else can offer to your customers. Nowadays, we understand that online business, it's very important even for those businesses that rely mostly on the in-person connection with customers. We need to offer options to our customers. If you have an in-person business, you can expand this business if you choose to go online as well. You need to be careful about your inventory. You need to make sure that you're not going to hold too much inventory, but you need also to be sure that you're not going to hold too little inventory. You need to make sure that you understand your needs and manage your inventory accordingly. Billing customers promptly, it's very important. You need to make sure that they're going to receive the amount related to your sales, and you're going to receive as quick as possible because you need this money to finance your company's growth. On the other side of the equation, we have our cost of capital. The main thing that you need to reduce your cost of capital is to understand your cost of capital. Because if you don't understand your cost of capital, you're not going to be able to reduce it. One of the most important things after you understand your cost of capital is to plan in advance, to know when you're going to need resources. You should not borrow money too early and definitely not too late. You need to understand the exact time when you're going to need resources and borrow money accordingly. You need to invest in technology, right? We have so many discussions about AI nowadays and how AI can improve your business efficiency. You need to make sure that you explore this opportunity. You talk with professionals, experts in AI to see how you can leverage this new technology to run your business more efficiently. And this would potentially reduce your cost of capital. You need to negotiate your credit lines. You need to make sure that you have the best credit lines available to your business. This is another point that the Small Business Development Center may help you to understand what's available for your business out there. And you need to maintain accurate financial statements. Your financial statements are very important, not only for tax purposes, but also to make sure that you know where you can improve, what you can do to improve your business value. In conclusion, I want to leave this presentation with an idea that relies strongly on cash flows and cost of capital. We need to understand that these two items are extremely important for your daily operations. You may think that you are going to think about these items only when you discuss them with your accountant or at the end of every quarter, but that is something that you need to keep in mind every day. What can you do to increase your revenues? What can you do to make your operations more efficient? And what can you do to increase the size of your business? At the same time, you need to make sure that you understand your cost of capital to be able to reduce it, to reduce your business risk. At the end here, you need to play two very important roles in your company's operations. You need to be your best salesperson, and you need to be a very effective bookkeeper. These roles are going to help you to increase your cash flows and reduce your cost of capital. At the end, what should you keep thinking about after today's presentation? We need to understand that financial statements need to be accurate and reliable. We need to understand the different reports in your financial statements. You need to understand what a balance sheet is and how you can use it to run your business more efficiently and effectively. The same way that you need to understand cash flow statements and use them in a similar manner. You need to understand that your customer is the most important part of these equations. You need to deliver to your customer what your customer needs when your customer needs. We need to keep focus on growth opportunities. You need to understand that you're going to have these opportunities, but you need to plan ahead. Always understanding that you're going to have challenges, and you should plan accordingly. You are not alone in this journey. You have many resources that are available to you. One of them is the Small Business Development Center. Other resources are related to universities, communities, local authorities. You need to explore these resources and use them as much as you can. You need help to run your business. We all need help to do our jobs, and you need to understand what's available to you. I know that I have discussed a little bit about questions and answers, but I believe that I have a little bit of time to answer more questions if you have. So thank you so much.
Hey, thank you, Dr. Marcus Brava Alves. If anybody has questions, just feel free to just drop it on the chat.
Thanks so much, everybody.
As we wrap up, I want to say thank you to everyone who joined this webinar today. And thank you, Dr. Braga Alves, for presenting such helpful information to our attendees. When we close the webinar, you will see a survey on your screen. Kindly let us know how we did today and let us know future topics that you would like to see in the future. With that said, have a wonderful rest of your day. Thank you, everyone.